moment of truth. It has arrived. This is the part of the trading week where that data that everybody has been anticipating is now directly in front of us. Of course, the markets have been rampant in their speculation around Fed monetary policy over the past several months, weeks, days, with all of the vigor that they've had around the subject really since the middle of 2021. And we are now looking at the next chapter in this saga, the next important waypoint, December's U.S. inflation data. Welcome. This is, of course, Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to do is have a look at what this data is expected to look like, have a look at what it's probably going to do for the financial markets, see if perhaps we can figure out what that's going to look like, and then consider what could be a trading perspective and what can be actually done with this information. So let's first get a bit of a foundation in place here and see what is expected and what is on the menu. So this right here gives us a sense. We can see that we have here U.S. CPI broken down into goods, services, food, and energy. The headline number you see there is going to capture all of that. And the core number is going to exclude food and energy. And we can see here that the story, as far as expectations are concerned, seems to be shaping up in both the Fed and the market's favor. So the headline number is expected to come up a little bit from 3.1 to 3.2%. The core number, however, is expected to continue to show continued disinflation. And here we are looking for a downtick from 4 to 3.8%. Now, when you consider the Fed's limited agency to influence, at least directly, energy and food prices, because generally they're a function of what global markets are doing in the supply and demand assessment of those things at a worldwide level, the headline number is relatively secondary, if you will, to what is going on in the core, because that's where the Fed can really do something. Furthermore, it's certainly not difficult to spot that goods inflation has been essentially squeezed down to zero. Energy has been the main kind of pivotal influence up or down on the headline. That's the yellow bars you see below the zero mark there, essentially telling you how much of a disinflationary or a deflationary influence, depending on the month, crude oil has been basically since the start of 2022. You can see that the peak in oil's influence on inflation on the upside was somewhere in 2021 or so, and now we're starting to come off. And of course, the most recent period here has actually seen oil prices contributing negatively to the inflation story. Food is getting slowly squeezed down. That's a global phenomenon and not at this point a meaningful contributor to inflation, at least in the U.S. It's a different story elsewhere. But what we see, though, is that services continues to be an area where things are sticky. And to the extent that services are where the core inflation trajectory is built, That seems to be giving us expectations that actually those things that both Fed policymakers and financial markets want to see will continue to occur. Here is a look a little bit deeper into what that services situation looks like. Here is a breakdown of those components. And we can see here very clearly that housing is, of course, the lion's share of the inflation component. But this is arguably not anything the Fed can really influence with further rate hikes. As a matter of fact, it is in some ways, in many ways, a consequence of the Fed's own actions. What the Fed has done with raising interest rates as quickly as it has is made mortgage rates that one could go out and get much, much higher than those mortgage rates already locked in by existing mortgage holders. The average rate on outstanding mortgage debt in the U.S. is almost half that of what is available in markets now. Now, that number has come in a little bit. It's not that long ago that mortgage rates were closer to 8%. They're hovering with about a 6 handle now, but the average rate on outstanding mortgage debt in the U.S., most of which is 30-year fixed rate, is less than 4%. It's around 3.4, 3.6. So what we're looking at is a very strong disincentive for people holding those mortgages to sell their homes. So there's virtually no supply, and the price can't really fall. It also means that folks are encouraged to stay in their homes because they don't want to sell something financed so much cheaper than what they would be facing if they bought something else now. So we have a kind of perfect storm in the housing market. On the one hand, you have a price that won't fall. On the other, you have rates that are still much higher than the mortgage rate that people have already locked in. So it's a situation where the Fed probably needs to start cutting in order to unlock, essentially, this part of the market. There's not really anything they can do about this by holding rates higher or hiking them further. If we strip this out and look at the so-called super core reading, so that's services excluding energy, excluding food, excluding housing, we are left with a much more reasonable situation. Inflation here, we can see, has been steadily declining. The pace of that decline has slowed a little bit recently, but the overall direction still seems to be generally in the desired direction. And so against this backdrop, the Fed is, by broad-based reckoning and by its own kind of all but overt signaling, ready to start cutting rates. And this is, of course, the main thrust of what has been the driver of explosive gains in markets in November and December of last year, as the Fed started to come around publicly to that perspective. And so what we see here in terms of Fed policy expectations from the November FOMC, where the Fed started to lay the foundation for a dovish reversal in a more obscure, more obfuscated way, then down to the December FOMC, where they essentially endorsed more overtly the idea that rates have probably peaked and cuts are now coming. And up to now, that's the solid line you see here. We can see the markets were listening to what the Fed was saying long before December's more overt admission. Most of the policy shift here occurred from November to December, at least as far as expectations. You can see the path for rates has now barely budged from that mid-December meeting up to now, almost a month later. But the path for policy that this envisions is, of course, much flatter, and rates end up much lower 1 year, 2 years, 3 years out, even 6 months out, than they did when we were looking at this after November's FOMC. And of course, the impact on markets has been difficult to miss. Here's the S&P 500 here in the red, and in the gray is the number of rate cuts expected between January and December of this year. We can see as those rate cuts build from about late October, early November, to saying we're going to have 1%, give or take, in cuts, to now saying 1.5%, as 50 more basis points in easing essentially entered into this outlook, we now had an impressively dramatic rally in risky assets. And of course, as we can see here as well, the bottoming in late December in these rate cut odds also established a ceiling on the S&P. So it's very clear to see the interrelationship between these things. Now, it is a similar story for the US dollar, which of course is a direct reflection of the price of money in so much as it is the money. So what we have here is a decline in the dollar that very clearly echoes the build in rate cut expectations. And again, as those rate cut expectations anchor, so too the dollar has found a way to come off the lows and start to poke its head above water just a little bit. The trend, of course, still unmistakable, as it is for stocks as well, at least for now and until something different materially occurs. And this, of course, is the main question. Will something materially different get touched off by this CPI data? Well, let's see where we are. So the current setting of expectations has us with the first rate cut no later than May. We can see that by May, one cut, and that's the number of hikes or cuts column on the left there. You can see by May, one cut is already in the forecast with a 57% chance that a second one is already coming at that point. The likelihood for a sooner cut in March is about 68%. That's a cumulative number with the slight 4.5% chance for a cut as soon as this month in January. Markets obviously don't think that's very likely at all. The likelihood is higher at about 64% individually for March. So take that together, and between this month and March, we're at 68. By May, that cut is in, and there's a 57% chance for a second. By June, the second is there. By July, the third. By September, the fourth. By December, the fifth, with a 57% chance for a sixth. So slightly higher than even odds that we are going to get the full 6 cuts. So the markets are essentially benchmarking this at about 1.25 to 1.5 percentage points in easing this year. That's the baseline against which we are pushing off. Now, if we look at data from Citigroup here that is tracking the performance of U.S. economic data relative to forecasts, what we find is a sort of convergence between expectations and reality. And we see it really start to develop from August onward. So from about, let's call it, May or so and into August, we can see US economic data is meaningfully outperforming forecasts. And you might argue that this is happening against the backdrop of negativity around the SVB-led banking crisis, as well as the fiscal risk around the debt ceiling debate at that time, that being essentially worked away, that the data really wasn't terribly impacted, but expectations were, because the markets were coming in with all kinds of doom and gloom speculation at this very time, because of course there were these dual risks hanging over the market's heads. And so the data was outperforming because expectations were weaker than they ought to have been. It's also very interesting then that we get those crises basically ring-fenced and mostly addressed, at least for the time being. And then we start to see the data do less well in relative terms against forecasts, largely as those forecasts are revised. And so the bar for an upside surprise on the economic data is being raised higher. We can see that when we look at this Bloomberg survey of GDP growth expectations for 2024 and 2025. Now, the 25 outlook is basically a flat line, give or take, with a jiggle here and a jiggle there, because that's really way too far for the markets to really have meaningful forecasts around which to speculate. There's way too much that is set to happen in 2024 with what's happening with the Fed, with the political cycle and the election in the US, to really make this call with any kind of meaningful two-sided debate at this point. But the 2024 outlook, that's been on the move. And we can see that it gets a meaningful upside revision starting, shock of shocks, right around mid-August. And it's starting to go higher at that point. We can see against that same backdrop, this economic surprise index starts coming down and is now basically hugging the zero line. What that essentially means is that the variance, the gap between expectations and realized results has essentially closed. What that means in terms of the CPI data is that we're probably looking pretty solid on these expectations. The markets probably have it about right. And so when we look at then this baseline, chances are we register pretty close to what this is. And then the question becomes, well, what part of this sort of a setup jettisons the Fed rate cuts outlook? Is there some sort of a move in the opposite direction on this basis? Even if it doesn't materially change economic reality, does it in any way take the steam out of these moves? And the bottom line really seems to be this. What we have here are the priced in inflation expectations from the market's own supply and demand, buying and selling in the key assets that give us a view on not so much what an economic model is going to predict, not so much on what somebody's opinion is, but the actual buying and selling activity of people making bets on U.S. inflation. And what we see here is from about, let's call it October, mid-October, give or take, we have the slide in 12-month U.S. interest rate expectations. That's in the green. And in parallel, a slide in inflation expectations, both at the bond market level. That's the yellow line there, the 2-year U.S. Treasury break-even rate. That's a measure of inflation expectations that's derived from taking the difference in nominal yields and inflation-adjusted TIPS yields, and then ending up with that inflation adjustment as the residual. We can see that's comfortably close to 2%, the Fed's target. And then, of course, the 1-year inflation swap, that's comfortably near 2%. So what we're looking at then is the market seemingly telling the Fed, you're good on inflation. You can stop. Because what we have here is expectations for rate cuts coming alongside falling inflation in the outlook. If the markets thought the Fed was too early, if they thought that inflation still had room to go higher, wasn't really contained, and the Fed was giving us dovish signaling, then the decline in rate expectations would send inflation bets higher, because the markets would understandably reason that the Fed is going to let the cat out of the bag here and backslide. But that isn't what we're seeing. We're seeing these things move down in tandem, seemingly saying inflation can continue to go down and will continue to go down even as rates are cut. So go ahead, Fed. This is fine. With that in mind, we look at a as expected CPI number and say, well, what's not to like for stocks there? There is a gap of 2 weeks between this report and the next major inflection point in this story, which is going to be a first look at fourth quarter U.S. GDP numbers, and that's 2 weeks away. Now, of course, this doesn't mean that some sort of event risk won't come out of left field. It absolutely can, and change this calculus even in short term fluctuations kind of sense, at least as far as the price action is concerned. But the underpinnings here seem to have a market that's telling the Fed it's time to cut, a Fed that's saying, I hear you, we're going that way, and inflation data saying there's nothing really here that should discourage a move that both of you all want, whether it be Fed policymakers or the market. And so what may happen here, as long as the inflation number is as uncontroversial as it seems likely to be, is a situation where the markets say, right, so nothing to see here. Let's replay November and December, maybe with less vigor, maybe with less intensity, but the path of least resistance seems to be, well, if it's not broken, don't fix it. So the bias seems to be in this direction, basically resuming, at least to some extent. So stocks maybe get the green light to keep going. Bonds maybe get the green light to rebound. And the Japanese yen, which has been thrown for a loop by unexpectedly soggy domestic data, may well resume its role as a kind of foil to Treasury yields. And if they start coming in and bonds start going higher with stocks once again, perhaps the yen, which looks very battered over the past several days has the impetus it needs to find a bottom and reassert itself. And that is macro money for today. As ever, we are here right after overtime, show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day, what that might mean going forward. I'm also on with Chris again for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com. In fact, this very analysis in abridged written form is already there. And also opining sporadically on the platform formerly known as Twitter, @IlyaSpeedback. Thanks very much for joining. Happy trading. See you guys tomorrow.